Hello, everyone. Thank you all for joining us. We're still a few minutes away from starting, and we've had an amazing response. So we're just going to wait for a few minutes so everybody has a chance to start off. So we'll be starting over the next 4 or 5 minutes at most. So hang tight. We'll see you there soon. Hey all, for everyone that's joining in, just a reminder that we'll be starting over the next few minutes. So get yourself a coffee, a notepad, some pen and paper, get your questions ready, because we have some great folks from HDFC who will be joining us. I can see they're already on the call. We've had an amazing response, so we'll just wait for as many people as possible to join in. So it won't be too much longer now. All right. Thank you all for joining us this afternoon, depending on where you are in New Zealand or Australia. It's wonderful to have such an amazing response. First of all, I'd like to thank HDFC Mutual Fund to be able to do this. Mr. Ashish Jagnani is the one that will be speaking to us all today. And really, what we're trying to get out of this is in the middle of all that has been happening over the past year, including currency depreciation, the West Asian conflict, tariffs. There's been constant pressure on both the equity markets in India as well as the INR itself, which obviously living outside of India causes a big effect in your Indian investments. This will be phrased in two parts, wherein we will tell you some of the basics of what investment is and what it looks like for an NRI living in New Zealand or Australia, followed by which Mr. Ashish will come and present HDFC's view on the market and where they see this going. I will be asking a lot of the questions that you guys had and you guys sent in the forms. After which, during the presentation itself, after which we'll have a comprehensive AMA, which can be live. So you can start putting in your questions for that almost immediately. And we'll try and get as many of those questions answered today as we can. So without further ado, let me sort of kick off and welcome you all. Thank you for joining us. Today, we're here to discuss what the current market cycles look like, what investing in India at this period of time means for you, what the risks are, and how you can potentially combat some of these. So let me kick off with a small introduction of myself and Indus. So my name is Jay Goradia. We started Indus about 2.5 years ago. I'm an NRI based primarily out of Auckland and Sydney, and I had the personal problem of wanting to invest in India, like many of you. Me and a few friends of mine started Indus, and since then, we've been able to successfully solve this access problem across Australia and New Zealand at least, which was a previous sort of long bureaucratic process of needing an Indian bank account, Indian paperwork, needing to fly to India, was essentially removed. And you can now access India's mutual fund market with a basic driver's license or a passport in your home jurisdiction and directly from your local bank account. We have over 500 sort of different types of mutual funds available on the platform itself. We've been lucky enough to onboard over 15,000 investors over the past year and a half in New Zealand, and we have recently just expanded to Australia. So a quick rundown on how it works. Most of you might be familiar with this, so I won't spend too much time on it. But for those unaware, you can reach out to us later as well. You sign up using your local ID in just a couple of minutes. You transfer your New Zealand or Australian dollars to your Indus wallet. We handle all the India side sort of conversion, tax, compliance, and all the reporting that needs to be done. And you can withdraw into your local New Zealand or Australian bank account anytime you want. So we've tried to really make it feel like it's domestic investing rather than international investing. Indus is regulated across markets, and we're partnered with some of the largest institutions across these three countries. So we are a registered financial services provider in New Zealand. We're an authorized representative under the AFSL in Australia, and we're licensed by SEBI in India. Our banking partners across the ditch are ASB and BNZ in New Zealand. In Australia, we've partnered up with NAB, who's our primary banking partner there, and our global custodian is DBS India, which is Singapore's largest bank. We've been backed by Zerodha, which is one of India's largest stockbrokers, and we are also a registered distributor for mutual funds. And so a quick look of how the last 2 years have been. We got to host the Prime Minister. We onboarded 15,000 customers, met the community, and did a whole bunch of events with the community. So we're very thankful for the response we've got in New Zealand. Our launch in Australia has been covered quite well across the press. So that's really good to see for us, at least. And now I just want to sort of quickly highlight the benefits of mutual funds and why we chose this as our primary sort of first product. So mutual funds are probably the most common way of investing in India. In fact, they have increased consecutively for the past 61 months in the amount of investments made by domestic Indians. So it's a 6x growth over the past decade. And it is now stands at about 82 lakh crores. These mutual funds are a proven path to entering the Indian market, and there's a lot of depth. As I said, there's over 500 of them available on our platform, and they're also diversified in their very nature. So if you're someone who's not really interested in analyzing and studying the market, mutual funds are perfect for you because they give you diversified exposure to a specific asset class, an industry, or whatever of your liking. So the core question comes to why India, right? And we've read these sort of macro factors a lot ourselves, which is India's got an incredibly young population. How's this for a statistic? India has 920 million people below the age of 35. So how's that for a workforce, right? It has the largest young population in the world, nearly 1 billion people below the age of 35. There's a huge domestic led demand. And this is important, especially in times of crisis, when there's pressure on exports, when there's pressure on sort of dealing with geopolitical risk. Because India's growth is powered from within, it has sort of largely been insulated, or the economy has largely been insulated. As I said previously, there's been record number of Indians participating in retail equity markets. SIPs are an all-time high. And obviously, like us as NRIs, we are a generation that sees India as a very near and dear market that we'd like to participate in its growth story. But these are just macro factors, right? And what actually changed in India over the past 10 years is super important to look at, because everyone quotes these big picture numbers. So let's actually do that. Let's look at what within India is actually growing and how is it actually making an impact and what rate is it growing at. So this was a really cool infographic that we saw, which essentially showed you the growth over the past 10 or 12 years and how sort of India has increased its capacity, its production, its electrification, its urbanization. So if I just look at some of the factors over here, it has had a 4x growth nearly in ports, a 2x growth on airports, etc. So over here, you can see that India has been on an infrastructure level and an energy level continuously growing, almost at least doubling over 10 years. And if you look at whether it's digital payments, fintech, industry, or simply sort of wellness and dealing with sort of people-based growth, for example, the drive to build nationwide toilets, the electrification of almost 100% of villages in India, the reach of Jio's optical fiber network, the number of internet users, the digital payments infrastructure, India has seen a largely explosive growth, which has enabled a huge amount of people to enter, number one, the formal economy, and number two, gain benefits from this formal economy and increase further consumption. So that's a little bit of our case on India. Everyone here is largely on the same page and is sold on the idea of India over a long term, at least, growing. But we asked you guys to all fill out some questions. The most popular ones, without any surprise, really, the number one question was, hey, the INR is getting absolutely smashed. And that's a question I have as well. And so it's great to have this forum to ask one of the best financial minds in the country what he thinks is the case with the rupee, whether it's due a bounce back or whether it's going to get worse before it gets better. Why India specifically over other options that we have, like the US, property investments, or let's say other emerging markets? What returns does India actually provide historically, as well as perhaps in a forecast nature? Is the best already behind us, or are we still to ride that wave of growth? Obviously addressing the global political climate, which is, and how we sort of look to maneuver that. What does investing look like at a time of crisis? Have we been here before? What happened back then? And finally, a question that sort of perhaps I can actually help with is, how does tax actually work as an overseas investor? And we'll come to each one of these sort of methodically. But I think it's super important to address the elephants. I think these are the biggest elephants in the room up front. So Mr. Ashish can, during his presentation, perhaps inculcate some of the answers, keeping in mind there's a lot more questions coming in the AMA at the end of this as well. So you can put your questions right here in the Q&A section, and we'll be happy to go through them and ask Mr. Ashish as many as we can. So without further ado, I would like to invite Mr. Ashish Jagnani, Senior Fund Manager of HDFC AMC. He spent the past 25 years in Indian capital markets. He's seen several decades of growth, slowdown, crisis, as well as crashes. So he's really been there and done that. He was formerly at UBS and Citigroup, covering Indian equities in both cases for global investors. So the perfect person to ask this sort of or to be asked these kind of questions to Mr. Ashish. So without any delay, I'll let you take it away, Mr. Ashish.
Sure. Good evening, everyone. And Jay, thanks a lot for setting the stage. I think importantly, so you've really put a real good stage and reduced my workload of why India this time, right?
Yeah.
But I think, I'm sure, all of you out here are grappling with the question that the world is grappling, that have we dealt with the kind of noise, volatility, global risk? Is that behind, or we continue to see that impacting the world markets and India in particular? While I don't claim to kind of give you a full view, but I'll surely try my best, and post that you should have a much informed view on the markets. Yeah. So, as Jai mentioned about it, right? India is a multi-trillion-dollar economy. I think what I've seen is that a lot of investors here are having their background in India. It's clearly adding nearly $1 trillion of GDP in successfully short periods. So what you see that the first $1 trillion was added in 58 years. The second was added in about 7, and we are seeing that continue to shorten. Our sense, looking at data and the way policies are happening, we think that this will accelerate and we will see a significantly large economy under creation. That said, I think clearly on everyone's mind is what is happening to the Strait of Hormuz. While your guess is better than mine, but I think clearly what I think is that this is choking supply chain for multiple sectors. What it's been talked about is more of energy, but what we hear is that this is an important pathway which kind of impacts a lot of supply to not only oil, LNG, chemicals. By the way, I think some of this does benefit Australia though. Yeah. But the important question to ask is that if this is not resolved, really, are we kind of seeing a larger impact? I think that's something which everyone's grappling with. That said, coming to India, I think in these circumstances, we are entering this crisis with a relatively sound fundamental. So our current account deficit is pretty much under control. We do kind of have growth rates being amongst the fastest amongst most of the economies, and I'll touch upon later. Forex reserves, which some of you all would have questioned, are very low, but I think over the last few years, we've really built this up significantly. Yes, in the interim, inflation is something of a worry, but we think it's manageable, and I'll also add upon later. I think the important point to highlight is primarily the fact that India has a very large consumption economy, which kind of makes it an outlier. So I think if you move to the next slide, so what is India's USP? It's clearly the most diversified sectoral markets amongst EMs. And if you really see this chart, the first tab is the couple of sectors exposure that India has on MSCI indices versus someone like a Taiwan, Korea, which is extremely, information technology and semicon oriented. So that, in our view, is a very, very important USP. At the moment, India was at the receiving end. But as things stabilize, I think we've already seen the volatility start in markets of Taiwan and Korea after a phenomenal rally. But I think India has got a place to be in over the next 5 years.
So I had a quick question in there, Ashish, and this is a question that we've actually received a lot. So perhaps you could speak about why this diversification sort of matters, right? And within the context of what happened yesterday, wherein essentially 2 or 3 companies, having a such a disproportionate impact on the market, so much so that Korea had a trading halt on its equities yesterday. And yeah, if you could just touch on that a little bit.
Sure. So it is, clearly a function of, what sectors and stocks kind of dominate the market cap. In the case of Korea, just the 3 stocks that we've seen a phenomenal rally over the last 1.5 year is close to, if my numbers are right, it's close to about 68-70% of the market cap. So
Oh,
if you
wow.
see
Of
a
the entire
sell-off,
exchange.
yes. So if you see
Okay.
a sell-off, you can see a very, very sharp reaction on the index itself, which is what we saw. Because the earlier night we saw US AI stocks having a very sharp correction, close to about 4% was Nasdaq, and that kind of replicates on Korea. Even for Taiwan, I think the exposure to my understanding is close to about 80%, particularly the semicon entity, and which is where, and some little bit of chemicals. But again, they are very, very, aligned to the fact that any vulnerability on semicon can hit them significantly. And that's what we're seeing. Whereas in India, we have been on the receiving to some extent for being more IT services oriented. So we haven't really got that benefit over the last 18 years, sorry, 18 months. But I think the consumption aspect, the banking aspect, the industrialization aspect are very lucrative sectors which are now open to the larger foreign investor base, which I think is not available in some of the other economies. So that's, in my view, the USP that India offers. At the moment, as I said, it was something being ignored, but now as things stabilize, which it should, there will be a lot of investors wanting to focus on that.
Perfect.
So the point I was trying to highlight is is here as well. From a data point standpoint, India is now emerging as the third largest consumer market globally, and more importantly, it's about the fastest growing consumption economy. So if you see, the U.S. consumption market size has increased from $11 trillion to 20 last year. China has moved from 3.5 to 7.9. And India, which was earlier below Germany, is moved for nearly more than double over the last at least 12 years. So I think that is something which people are right now ignoring in the AI and the tech boom. But I think with the consumption picking up, macro being relatively solid versus other markets, it's a very important thing to note. The other important thing, which I think most people ignore, is that always China is considered the global supply chain hub. But I think everyone here on the call would have realized that post COVID, clearly the supply chain shifts have started to happen. While India benefited initially, from the shift in global supply chain, but we are still in the process of building capacities. So what has India done? So it has basically tried to increase their focus on free trade agreements with some of the large economies. What we've already signed is about with free trade agreements with Europe. I think New Zealand is one of the new ones as well, and UK. Europe is one of the largest because nearly 23% of India's exports go to Europe, right? Which is huge. And we are also underway to do that for US and some of the other countries. So what does this do? It not only stays a consumption focused economy, but you have an option value of starting to participate in the global supply chain shift. And I think that's a likely position that India could benefit from in the next decade. Coming to Jay's question, everyone's question, rupee weakness is a concern. Completely agree, and I think it's for the reasons that the entire Asia or North Asia is kind of dealing with. But it's important to highlight that it's not only a concern for India. Other emerging currencies have also weakened, be it Indonesia, Thai, Philippines, South Africa, even Korea. After all this has seen about 3%. So I think this is something which is there on everyone's mind, and I would say that we are at the peak, if it may, to see this kind of apprehension, because we are still awaiting some kind of resolution to the US Iran conflict and its impact on oil. And I think that's the most important question mark which is there in everyone's mind. I would have given you an answer, but my answer would have been same what was there in January, that it's happening. And I think it's just kind of taking along. It's the only important thing is that India is learning to deal with it, and the inflation is slowly and steadily being passed on in phases, so as to be us well positioned once this situation eases out, which should happen in my assessment over the next 6 months, the way oil prices are.
So let me, within this context, Ashish, because this is quite obviously a hot topic, and I know we have a couple of sort of slides to cover exactly on this, but to just put in mind the context of these the INR slide. Now, despite, yes, it is a more recent sort of exaggerated movement. I think against the New Zealand dollar, it's fallen 10% in 12 months or something like that. And if you average it out over 10 years, it's something like 2% a year. But even if you weight the currency in, are the returns actually sort of disproportionately better than, let's say, other comparable large economies? Or is it just that most of my returns are being eaten away by this, hit in currency?
So, while it's a tough one to comfort, but what I will tend to do in the subsequent slides is give you how HDFC AMC funds have done over a 3 to 5 year kind of time frame adjusted for currency depreciation. And
Hmm.
that probably would be a good eye opener for most investors. In the short term, maybe your question is right. But if we look at a CAGR return of 3 or 5 years, I think there is still a reasonably healthy return to be made.
Gotcha. And just flipping that on the other side, right? Like, obviously, everyone sort of dooms quite a bit on the currency. Is there actually at a time like this where you believe perhaps we're close to the bottom or towards the end? What people have often told me is that, hey, there might actually be an advantage at entering at this price point. Does HDFC view this as a serious sort of currency benefiting opportunity, or is it more like, well, regardless of what the currency does, the macros are there?
So I don't want to jump my slides though, but definitely that's something that will get addressed. So this
Yeah.
is basically, if you move to the next, it just shows you that the Indian currency is similar to what we were in late 2013 during taper tantrum, right? So it's clearly showing that we're significantly undervalued. Maybe a lot of people would have questions that it's in the right situation currently, and which is why that is correcting. But if you move next, what we are trying to see, and our view is that this kind of an undervaluation rupee is extremely beneficial for foreign investors, particularly investing with a 3 to 5 year investment horizon. And why do I say that? Clearly, rupee appears, as I said, is extremely undervalued. We think that this undervaluation is more of a flow issue, which is where FPIs have been selling and relocating capital to other growth markets, but not fundamental. And I did highlight the fundamental exposure and the strength that India has in my previous slides. So that said, I think what are the catalysts going forward? Clearly, we think any moving progress on de-escalation on West Asia will be a very, very important aspect. We are seeing, despite all the reactions, oil has only been softening less than $100. I think everyone's working towards bringing it down and resolving. I think the other important aspect for India is GCC remittances, which is about 17% of flows have been choked initially, which is now beginning to happen. And with the way, valuation, which I will touch upon subsequent slides, we think that global capital will come back to India, which should benefit flows and the currency. Just to touch upon, and interestingly so, over the last 2 3 days, we've seen a significant amount of efforts from both the central bank and the government to actually bring foreign investors sharply in order to improve the odds of rupee recovery. Now, what do I say? Just yesterday, RBI announced clarifications on foreign exchange currency borrowings, that the hedging would be taken up by RBI and not by the banks, so which is to provide stability. Second, in order to improve bond flows, they've actually allowed foreign investors to invest in GSECs completely tax free, which is at least a tax of about 12.5% on a long term basis. So I think all of this should definitely help, triggering, the choked flows that we were experiencing over the last 1 year to kind of recover. Can it recover tomorrow, day after? I may not be able to tell you. But clearly, I think we are in the right space, and government and central bank both are cognizant of this. So clearly, I think what it says is, I think history favors patient capital. We at HDFC do believe that foreign investors are entering now at a corrected market with a deeply, reasonably undervalued currency. And what does that give you? One, capital appreciation and potentially currency gains. Now, currency gains looks like a distant, expectation, but our view is, looking at the data points, we should be able to do that over a longer period of time. And if you can move next, I think that will clarify the picture.
Yeah, I've just my phone's been sort of blowing up from a couple of people in this webinar because they were they had all the questions on currency. So guys, you can use the Q&A section now. You don't have to wait until the very end to put in your questions, and we'll try and address as many as we can. I know that this has been a super hot topic among investors globally, actually, that are worried about this. And this seems like quite a big development. And if you have questions, please feel free to ask them now.
Okay, so basically what we've tried to highlight here is from 2008 to April 26. Every phase of rupee depreciation has been followed by fairly strong market returns. Is this a guarantee for the future? Not really. But clearly there are enough sequences where, 2008 to 9, that was GFC, we saw rupee depreciate by 31%. The year subsequently saw the index kind of rally, 1 year, 118%. These are rupee returns, I would say. Second is also on a 3 year and a 5 year, there is still a fairly decent CAGR return, is what I would think. And even subsequent phases, when we've seen sharp sell-offs in the rupee, right? We've seen subsequent, returns that have been extremely enterprising, and the risk reward has been favorable. What we see in the last row is rupee has depreciated about 14% over the last 1 year. And your guess is as good as mine as to how we'll see returns, but we are fairly confident that we'll do pretty decently well. But for the fact that we should see this resolution that is happening in West Asia quickly, we are taking all the efforts as a government and the central bank, and I think that should play well.
So just to sort of make this really simple, Ashish, to sort of uncomplicate it a little bit, you're essentially saying that in the past, when there has been big swings in the rupee going down, or the rupee is depreciated massively, the next year the Nifty is given you sort of amazing returns. Any analysis on sort of potentially why that might be the case?
So it's a combination that one, the economy comes off a low base in all these impacted situations, and clearly we don't have it here. But I would presume for all of these events, earnings growth for the markets would have kind of corrected sharply basis the events. And when that happens, as I said in the previous slide, you see a capital market or corporate earnings recovering, followed by the fact that all the rupee depreciation that has happened on a recovery of earnings attracts FPIs again. So that's where you see a pretty extended return. It depends on the extent of vulnerability the economy has had as a function of those macro events. And that's the whole impact that kind of accelerates. Now, I'm not saying it's possible to catch a 1 year return, be it 118, 33, 29. But I would say that if you are looking at India, and you should look at it from a 3 to 5 year view, I think anything above a 15 to 16% currency adjusted is a very, very healthy return.
I agree.
So as I just briefly highlighted, I think earnings is something that India market follows very closely. India is a corporate earnings growth market. Clearly, the recent corporate earnings have been very encouraging despite energy challenges. Possibly there could be one more quarter or maybe two where you could see the impact of higher energy prices in corporate earnings. But adjusted for that, you still have a recovery in MSCI India earnings from nearly a 10 rupee growth to 14 to 16. I would probably be realistic in assuming this 14 to 16 could be between 11 and 13. But nevertheless, I think that is still a very, very decent growth that India would deliver. And that is something which should interest long-term investors. And that is something that we highlighted in the previous aspect as well.
So just to touch on this maybe a little bit more, so this obviously earnings will directly put sort of the PE ratio in people's minds. It's probably the primary indicator they look at least to try and understand, get a sense of valuation, right? Like so at hovering around, let's say 20 PE, is the Nifty sort of appropriately priced, perhaps cheap, expensive? I know that's the question that everyone wants the answer to. No one seems to have for sure. But is there an opinion that you guys currently have on that?
Surely, I would have said I have an opinion for sure. But I think, again, I'll probably take it in the next slide, which can give you
Yeah.
a slightly better idea as to where we stand, right? Sorry, I have a sore throat, so please, excuse me. So if you see, from a GDP growth standpoint, despite all the concerns on energy crisis hitting India a lot more than some of the Asian economies, we still think that the markets are assuming that India would grow faster than most emerging markets and developed markets, both this year and next year. We are looking at between estimates are anywhere between 6.2 to 6.6%. This is real GDP growth. If I add inflation, it would be something like 10 to 11% GDP growth, right? So that is still makes India, which I highlighted, that it's the fastest growing market. And I think that's something which cannot be ignored. What we were competing was, index of Korea, Taiwan growing at 70, 80, 120%, driven by concentration of some sectors. But I think now when that has kind of plateaued or probably well discounted by markets, this could be one aspect which most long-term investors should focus on.
Cool.
And
Before, sorry,
sorry.
I just like to address the fact that we have a couple of questions in the chat. So before we, perhaps we'll take a one and then we can sort of continue. So this question is for Ashish from Ashish. Hi Ashish Ji, my question related to expense ratio. Why expense ratio is getting higher while fund is poorly respond? Who is responsible? Well, Mr. Ashish, I can answer that question. The expense ratios are subjective to each individual asset management company. Lots of them have sort of different levels of expense ratios. We on Indus through the platform, what you can actually do is filter for expense ratios and see the funds with the lowest expense ratios. And if that's a big sort of barrier to entry, then you can sort of filter it out over there. So that sort of probably answers that. And a sort of quick question, which will probably lead into your next slide, Mr. Ashish. So I might as well ask it so you have some context. As AI usage accelerates in India, how do you see this impacting employment and consumption growth?
Yeah, thanks, Jay. So basically, I'm sure, this is a most talked about point globally, whether you're sitting out of New Zealand, Australia, US, or any part of the world, right? India, while is looked at that we are anti-AI, but I think everyone's familiar with data centers. Data centers is something that is the core hub to kind of roll out AI models, not only in India, globally. Yes, we have been slower than the world catching up on this, but what we are seeing now is exponential growth playing out on Indian industrials, following the sharp data center capacity that India is going up with. So just to give you numbers in perspective, while the realistic numbers say that we would go from a 1 gigawatt to about 6 to 7 gigawatts, there are all estimates to move this to anywhere between 8 to 10 to 12 gigawatts by 2030. Your imagination is as good as mine that can we do that execution. But clearly, what we are seeing in the numbers of some of the companies that are a part of this value chain are closely reflecting that. So we're seeing this is basically driving the huge capex cycle in India, a different form than what we'd seen earlier. Earlier was just infrastructure. Now we're having basically electronic infrastructure which is building, and we will have to see how that rolls out. But there is good optimism that this will happen, maybe not in 2022, 2030, but even 32. It is still a 5x exponential growth which will benefit a lot of companies, and we are seeing that happen in terms of order flows, right?
Okay.
Secondly, was your question on AI, right? As I
Yeah.
said, India is not at the forefront of AI development, but we are at the front foot of collaborating with AI developers. And that you can probably Google. There is enough stuff that is there across the globe where the larger players are tying up with Indian tech companies to handhold on implementation. And we are strongly of the view that AI may not be driving the first set of growth, and we have seen that concern on job loss and all of that. But I think as we progress, there will be a lot of development where AI could emerge as an opportunity. It may not be immediately driven by employee growth, but I think volume growth is what is happening, and we are seeing that across quite a few of the larger well-established Indian IT companies where their order value or volume is growing at 10% plus. So clearly, that gives us comfort. Yes, we are seeing a kind of sharp sell-off, be it currency, be it all of that. but we think that it is an opportunity in disguise for people who are patient, and you'll have to look at it with at least a 3 to 5 year view. We see it very similar to the concerns raised on cloud, right? Cloud
Mhm.
adoption was a similar question mark for Indian IT. And while this is a different phase, every technology is a different phase. So I think that's the way to look at this.
Yeah, sure. And just touching on AI, because it's obviously quite a hot topic, right, globally. Do you sort of, have you guys internally considered, or have you obviously through your research come across any specific sort of layers within, so obviously within the AI context, there's different layers, right? Like closest to the customer would probably be the application layer. You'd have the agent layer, the context layer, the sort of model layer, and probably the energy sort of layers, right? So, do you see anywhere across this, let's say, value chain or supply chain that India is particularly sort of geared towards succeeding at?
Sure, Jay. So I think it's a tough one to answer. I don't think even the CEO of Infosys, TCS are kind of put their neck out on the line there. But the way I would see it is clearly an efficiency enabler. And Indian IT is focusing on that. There are a lot of pockets where the impact of AI development is far lower. And, I don't want to make guesses here, but what our research says that there are a lot of pockets, digitally enabled application developers who are seeing a lot more growth as a function. Yes, the current overarching impact of narratives is kind of hitting Indian IT, but my view and our internal thesis has been that volume growth will tend to surprise. Yes, there can be a little bit of margin headwind when they transition there, but volume growth will surprise and drive lower expectations in Indian IT. And more importantly, being a house like HDFC, we value, margin of safety, growth, cash flows, superior return companies. And we think that it has, a good traits of all of that, and which is where we are fairly constructive.
Perfect. Thank you so much.
So the second and most important point, which I think people are, ignoring and moving into the other direction, ki why, foreign investors are selling. But the other point to highlight is you see the conviction of domestic investors. You're close to see last year inflows of $90 billion. This year, as of now, this number of 27 is only till March. I think this number has improved to about 34, $35 billion. So that gives us a lot of comfort that Indians investors themselves are extremely positive on the India growth. And that shows the resilience of having to absorb all the sell off that foreign investors have happened. Had that not been the case, I think we would have seen a much sharper sell off on the rupee. But clearly, if you see the chart on the other side, the ownership of Indian equities has moved from 15% to now close to about 23, 24%, which is extremely high and encouraging. So I think that should be something that should be focusing on. The sell-off is already built in the market, and I think that should give most long-term investors conviction that locals see a lot of opportunity here. Coming to Jay's question, how does valuations look? So I think clearly we are trading below 10-year averages. This is MSCI India valuation, which is the most tracked global index for India investors globally. And that's probably trading below 10 years. With all the stuff that I've highlighted above, our understanding is if earnings growth is on a recovery mode, this kind of a valuation, which is a peg of 1.2, 1.3, or maybe peg can be even lower, is a good, attractive risk reward opportunity. Again, for investors which have a longer term mindset and not just looking at 3 to 4 months and a currency trade. Yeah.
So just putting the context of a PE ratio really simply, Ashish, perhaps it'd be easier to sort of explain what it is for some people who might be newer to the concept. So can you explain what the obviously everyone knows what the stock price is, but how that sort of ratio works with
Sure.
earnings per share? And you also went back, previously in a previous slide, you spoke about, EPS is expected to grow up to 14 to 16%. Within that context of very high EPS growth, does current or trailing PE averages make sense, or should you look at more sort of 2 year, 3 year forward estimates based on this earnings growth to decide?
Sure, Jay, it's a very valid question. Again, it's a little bit of guesswork and the comfort of what individual investors want to look at. Our sense is that typically, just for everyone, the way what does PE mean is basically price of MSCI index versus divided by the earnings growth of the companies that form the MSCI index, right? So typically, if you really see market when they actually move to something like 23, 24, they were relatively richly valued. Having that come off with earnings growth recovering, it's a good indicator that markets have not been cheap, but they've been realistic in context of what they are. The growth that we've highlighted or the P that we've highlighted here is a 1 year forward, which is reasonable. Usually people who get aggressive look at 2 year because 1 year doesn't suit them. And most conservative look at, historic,
Really.
right? But you will always miss the woods if you try and, focus too much on historic because those can be a little more exaggerated. Having said that, I think in our understanding, this is a good level where there is margin of safety. But again, I would stress this is from a longer term perspective and not from a short term. So again, to give you a perspective as to how past crises have been opportunities, and here the first column that you see here is basically what we saw was in global financial crisis, the some of the key benchmarks actually corrected about 60 to 63%, and immediately subsequent after that, the benchmarks bounced back 70 to 80%. Similarly, what do you mean by the macroeconomic shocks? This covered basically the COVID impact. It covered basically, the interest rate hike that we saw across markets post COVID, and a lot other sequence of events which were negative for the globe. There we saw indexes on an average level correct 35 to 40, 35% odd. And post some resolution and stability, the markets bounced back again 34, 35 to 40%. Coming to the current Iran conflict, we've seen markets come off about 14, 15%. For some of you may feel that it's not significant enough, let it fall to 30%. I think you can continue to wait. But if macro is turning and growth is turning, we would see a good probability that its return could bounce back good, right? But again, you have to take a slightly longer term view, which is what something I've been stressing throughout. So just on markets to wrap it up, timing equity market is hard. I'm not sure if I gave you a very good view of it, but the only suggestion I would make, it's the best time to enter markets and be a contrarian. This blue box does give you a sense that after every market crisis period, the 1 year returns have been significantly higher, something that we touched upon earlier as well. So it is a good contrarian position to be in, provided A, you have a slightly longer term view, and I hope the good part is that in this current year, this volatility would give you a good entry point in some of the promising companies, which you can hold and build on returns over the next 3 to 5 years. With this, I would kind of dwell onto how HDFC is positioned and HDFC strategy, which I think is important for everyone to understand. HDFC AMC has a very, very robust investment process. We focus on quality companies, very fundamentally strong, as the fact that we think that is an incremental edge to avoid, momentum and look at the long-term wealth creation. Second and most important, we are usually not considered momentum chasers. We tend to have a contrarian and a tactical bend. Valuation is a very, very disciplined approach to our entire strategy. We try and evaluate everything basis on margin of safety. And we may be happy, leaving some of the opportunities where we think the risk of capital is higher. But we don't compromise on that because ultimately we are looking at a long-term return opportunity. Next. So what do we usually avoid in our strategy? We avoid companies with bad capital allocation, poor corporate governance, which are super expensive with no margin of safety. Again, poor quality managements where ROCs are extremely weak and cash flow visibility is low. This is our basic hygiene for trying to avoid any major mistakes. And that's where, HDFC has got its name amongst investors for longer term wealth creation, and probably you'll see subsequently how we are positioned. So this is giving you HDFC AMC just to give you a perspective, HDFC is amongst the largest AMCs in India, manages close to about $100 billion in capital. And these are some of our flagship equity funds, which have a very, very sharp and a long track record of returns. So if you just to understand this table appropriately, FlexiCap Fund has been our flagship fund. On a 3-year CAGR in New Zealand terms, adjusted for currency depreciation, we've generated about 16%. 5-year is about 17%, and since inception is about 15%. Versus if I see the index again on a currency adjusted basis, Nifty, which is the largest benchmark, is done 8% and 9%. So we have been able to deliver consistency based on our philosophy, and that is something we are extremely proud of. Having said that, disclaimer is that past performance may not be considered and sustained in future, but clearly across funds these are realistic and healthy returns which we basis our process would like to take investors in mind with. And second, if you see the next slide,
So
right?
sorry, quickly before
Okay.
that, Mr. Harish Mata had a question on this exact thing, that this chart has growth in rupee terms. Please share something in similar in US or EU. So you can see in New Zealand dollar terms what HDFC's AMC's returns were. We'll try and sort of put something up online for what the Nifty and sort of the overall market look like as well over that time in USD, AUD, and NZD terms as well.
Sure. So this is to kind of leave you with a perspective of flagship funds equity journey over the last 30 years has seen a capital return of 18%. This is
Sorry,
yeah.
Ashish, I think your voice is a little bit muted.
Okay, now.
Yeah, perfect.
Yeah, so what I was sharing here was basically our flagship fund's wealth creation journey over the last 30 years. And mind you, this is a rupee return because what we have highlighted is 100,000 invested in HDFC FlexiCap since inception over the last 30 years has generated 18% plus CAGR. Similarly, the index, which has seen a CAGR return of 11. So again, a decent form of alpha creation bases our process, which is what we've always highlighted, that we focus on long-term returns. And you may have cycles where we would have underperformed briefly, but over the long term, we continue to stand by our process. And I think the next slide will be extremely interesting for, after this presentation to get a sense of our, philosophy.
Oh, I don't think it's playing.
No worries. So basically, I would, I would like to summarize it. Next slide. I'd like to summarize it that, clearly geopolitical and inflation headwinds persist. But we at HDFC think India's macro strength and growth give a clear edge. Crisis, we see it as an opportunity, and long-term equity returns have favored the bold. From a currency standpoint, we do fairly believe that worse seems to be behind, especially with the recent efforts the central bank and the government have taken. And benchmark valuations are also below 10-year average, which is offering an attractive point. HDFC's investment strategy, the USP is looking at growth compounders, reasonable valuations. We stand by our quality portfolio, superior ROEs ahead of index growth, and most importantly, I think philosophy of long-term wealth creation. Our advice to every investor is basically, be a contrarian, avoid panic. We follow a very strong investment process in these times, along with patience, which in our view does give our investors a risk-adjusted return over the long term. With this, I'll stop, Jay, and happy to take your questions.
Yeah, sure. Thank you so much. So we have obviously a lot of questions that have come into the chat, as well as the Q&A that was submitted at the very start as well. I think what I'll start off with is I'll immediately address that one that's towards Indus. So this one's from Mr. Sumit Dua. Hi, Jay. The expense ratio seems higher for the same funds on Indus. Through Zerodha Coin, there are options for direct instead of regular growth plans. There's a difference of approximately 1 to 1.5% in expense ratio charges. It's high due to platform convenience, just adds up over time when portfolio size increases. So, I mean, this is something we completely agree with. However, the nature of sort of the funds we offer are regular funds. The very simple reason for this is because in order to do what we do, which is essentially charge you zero brokerage on your investments, the lowest FX fees in the market, your taxation end to end sort of solved without needing any remittance certificates or anything like that, to create the sort of infrastructure for the end to end. It unfortunately costs us money. We hoped it wouldn't, but turns out it does. And so the way we sort of make our revenue is through providing regular funds. Although we will take your feedback in mind, Sumit. So thank you for that comment. There's another from Mr. Sharma, which is, how is the market valuation from a price to book or a P to B ratio perspective? And then he had another one, which was, how does ROE and ROCE, which is return on equity and return on capital employed ratios of India compared to global companies? So that'll be right in your court, Mr. Ashish.
Sure. So I think from a price to book versus historic, I would think price to book would be higher because, again, my understanding would be historically we had a lot more, different configuration of the indices, which was more commodity oriented and all of that. As a result of which, on a price to book basis, the index used to look cheaper earlier. Important, and which is what we try to highlight, is what would be price to earnings ratio, because the the constituents of the market is indexes is changing, and in that context you may always find India expensive in on a price to book basis, right? That said, sorry, what was the second question?
The ROCE and ROE, so return on capital employed and return on
Yeah.
equity
So
compared to
there,
global.
sure. So there again, we are reasonable. I would say, again, there is no single brush that I can compare with other markets with. But realistically, if I look at the index, at the moment, given we are coming through an underperformance and earnings have been soft in the last, 15, 18 months, our historic returns, ROE and ROCE, would be somewhere between 11 and 13%, right?
Mhm.
Versus earlier, and some of the other markets which are very dominated by tech and semicon, they would have a much significantly higher ROCE if I look at it on a comparative basis. That said, with the earnings recovery happening, we think that you will see 200, 300 basis points of growth in ROCEs and ROE, which is what we tend to track, that going forward, if the new index constituents are showing growth recovery, you should see this as an improving trajectory, which is what we track closely rather than only tracking historic ROEs and ROCs.
Sure.
I hope
Thank you
that
so much.
answers, and provides some clarity.
Sure. And team, you can keep putting in your questions. So I have another one here from Harish Mata, who says, for any of your investment products, is there any visibility of the underlying companies where the funds are invested with a percentage mix, weightage, etc.? I can take that through our platform on the Indus app. You can see a breakdown of each one of the funds. So exactly to the granularity you've asked for, which is what the exact underlying companies are, what the breakup of the industries are. We also have an investment breakdown for your portfolio, which basically tells you if you're across 3 or 5 different funds, what your personal exposure might look at. So you can go into your investment breakdown and see that, what industries you're invested in or what your funds sort of mixture is like for you on a personal perspective. So the answer to that question is yes, it's all available on the Indus app, which you can download if you're in either New Zealand or Australia. So thank you for that question, Mr. Harish. I hope I've answered that sufficiently. There is another question, and I'm guessing this is dedicated to me. So, hi Jan, I've noticed that it is taking almost a week for purchased units to appear in the dashboard. The process from funds transfer, INR conversion, order execution, and finally allocation of units seems quite slow. Are there any plans to streamline or speed up this process going forward? It will be helpful to understand the expected timeline and whether any improvements are being worked on. Thank you, sir. This question is something that we've ourselves tried to optimize as much as possible. We are very much working on the speed at which we communicate with the ANCs, but just know that your order is sent across to an AMC or an asset management company almost immediately as you place it. Different asset management companies have different settlement cycles, but it's pretty typically within 2 to 3 working days, so T2 to 3. So we are working with the AMCs to help them speed up some of their processes as well, knowing that sort of some of the AMCs can be pretty analog in the nature of their dealings. It's something that we hope to do for everyone as well. So yes, the simple answer to that question is yes, it will get faster over time.
So, Jay, I would request if we can take one or two last questions as I need to step out for another call.
Yeah, sure. If there's, I think we've addressed most of the questions over here. I don't think I really see that many more. Yeah, if there's any other questions from Mr. Ashish, please ask them now. Otherwise, Mr. Ashish, if it's okay, we'll send them your way via email or something like
Sure,
that.
please do. Please do. Thanks
Yeah,
again.
no,
Sorry,
yeah,
go
I'd
ahead.
like to thank you so much, Mr. Ashish, for your time. And if there's any questions, as I've said, you can send them through to us, and we will compile them and send them through to Mr. Ashish.
Thank
I
you,
will still.
everyone. Sorry.
No, please.
No, so I would like to, take this opportunity to thank you, everyone, for our patient hearing. I hope this was useful in your understanding, and look forward to your contrarian approach to come into investing into India via the HDFC platform. Look forward to, if you have any further questions, please reach out to Jay and Vivek, and we'll be happy to help.
Yeah. Thank you so much. I'll just take some of the Indus related questions, guys. So there's a few
Can I
questions
log
here.
off?
Yeah, sure, Mr.
Sure.
Ashish. Thank you
Thank
so
you.
much. Thank you. So it says over here, hi, Jay, I've noticed, oh, I've already dealt with that one. So that one's done. New Zealand FIF has a $50,000 FIF rule. New budget says 100K is proposed. Any way to bring a joint account so a family can create a joint, so same funds will work for a family, and we allocate the 50% for each one of us for taxation purposes. That's from Mr. Fani Bhushan. Mr. Bhushan, yes, that is something that we have considered, joint accounts. However, due to sort of the KYC standards, what you can essentially do is you can essentially create 2 separate accounts, and the FIF rules will apply to you in the same way as it would sort of in a joint account. Although this is not sort of taxation advice, and we say always speak to a tax accountant, we're very happy to continue to work on this in the future and try and bring it to you if possible. So I think that's all the questions that we've received so far. Thank you all so much for this incredible turnout, and hope you guys all had something that you learned from this. If there are any questions, as previously said, reach out to us at support@investindus.com or support@indus.nz or support@indus.au, depending on where you are. And we will see you again with exciting webinars really soon. Thank you all so much.